Welcome back to NM Serena. In this video, we are going to discuss the fund-based financial services. The fund-based services includes equipment leasing or lease financing, hire purchase and consumer credit, bill discounting, insurance services, housing finance, venture capital, and factoring. In this video, we are going to discuss the fund-based services in detail. One of the important fund-based services is equipment leasing or lease financing. It is an agreement between the lessor and the lessee whereby the lessor gives the right to use and control the assets to the lessee. So the lessee can use the asset without buying and owning it. So in this case, the lessee firm, they acquire the right to use the asset. The firm must consider the leasing of the asset rather than buying it. In comparing the leasing with buying, the cost of leasing the asset should be compared with the cost of financing the asset through other normal sources of financing. Since payment of the lease rentals is similar to the payment of interest on borrowings and lease financing is equivalent to the debt financing, the financial analysts argue that only appropriate comparison to compare the cost of leasing with that of cost of borrowing can give the result whether the leasing is more profitable or not. Hence, the lease financing decisions relating to leasing or buying options involve comparison between the cost of debt financing and lease financing. A firm which intends to lease has to make an analysis whether leasing is more profitable than borrowing. So, leasing is a form of renting of asset. The lease agreements provide for a number of obligations on the part of the lessee, which do not form part of his implied obligations under the legislative framework. So, while leasing, both the lessee and lessor has got their own obligations. Before leasing an asset, the lessee has to analyze whether it will be profitable to him to lease the asset or to use the asset on a lease basis than purchasing it. The next type of fund based service is hire purchase and consumer credit. Hire purchase is a transaction where the goods are purchased and sold on an agreement between the hire purchaser and the consumers. Certain terms are agreed between them, such as the payment is to be made by the buyer to the hiree, that is the seller, usually the vendor, in installments over a specified period of time. And the possession of the goods is transferred to the buyer immediately. That is, the buyer can take home the goods as soon as the agreement is over by paying the initial amount on the down payment. But the ownership remains with the seller. The ownership is not transferred on sale of goods when the down payment is made. The ownership is transferred only after the last installment is paid. The property remains with the vendor, or you can say the ownership remains with the vendor till the last installment is given. After that, the ownership is passed to the buyer. The seller can repossess the goods if there is any default in the payment of goods. If the buyer is not making the payment on time, then the seller can treat the amount received by the way of installment as higher charges for that period, and he can take back the good. And each installment is treated as only higher charges or rental charges. Usually, the higher charges are interest on a flat rate. The installment in hire purchase includes this interest as well as the repayments of the principal amount. And the consumer credit includes all asset-based financing plans offered to individuals to help them acquire durable consumer goods. In a consumer credit transaction, the consumer or the buyer pays a part of the cash purchase price at the time of the delivery of the asset and pays the balance with interest over a specified period of time. And this consumer credit has emerged as an important asset based financial service in India. The main providers of consumer credit are the foreign or multinational banks, commercial banks, and finance companies, and they cover items such as cars, scooters, TVs, refrigerators, washing machines, home appliances, personal computers, cooking ranges, food processors, etc. And there is no specific legislation to regulate consumer credit in India. So it's a support given to the consumers to enable them to make purchases on a credit basis. They pay a small amount at the time of delivery of the goods, and then after that the remaining amount is paid over a period of time. That is consumer credit, which is almost similar to the hire purchase. Both are almost similar, or you can say one and the same. The next type of fund-based service is discounting of bills. Now, what is a bill? According to the Negotiable Instruments Act 1881, the bill of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So that is a bill. Now, how is a bill seen in the daily life? When a person is purchasing certain goods from a seller, the seller draws a bill of exchange on the buyer of goods on credit. Such a bill may be either a clean bill or a documentary bill that is accompanied by certain documents. This document may be document of a title to goods such as a railway receipt or something like that. The, the seller who is in possession of this bill, actually this bill is a promise given by the buyer that I will pay this amount after a specified period of time. That period will be stated in the bill. So it's a promise given by the buyer to the seller that I am owing you this much amount and I will make the payment on this date after this much period. And the seller who is in possession of this good, he may be in need of money then and there itself. Then what he can do is he can approach a bank for discounting it. Then the bank purchases these bills payable on demand and credits the customer's account with the amount of this bill less discount. This customer is the seller. So the bank gives the amount to the the seller, and this seller get the amount of the bill less some discount charges. These discount charges are taken by the bank. For example, if the bill is for 1,000 rupees and the buyer will have to give the seller 1,000 rupees, when this seller is depositing it in the bank or discounting it in the bank, the banker will give an amount less than 1,000, maybe 900 rupees. The 100 rupees being their discounting charges. And now the bill is with the banker. On the maturity of the bill, that is on the period mentioned on the bill, the banker presents the bill to the buyer, to the original buyer, that is the acceptor of the bill for payment. In case the bill discounted is dishonored for non-payment, the bank recovers the full amount of the bill from the seller along with the expenses in that connection. The development of a bill discounting as a financial service depends upon the existence of a full-fledged bill market. And the RBI has been making constant efforts to develop a market for the commercial bills. Although a bill market scheme was launched in 1952, actually in reality, the bill market grew in India only after 1970. And the RBI has permitted banks to rediscount bill among themselves and with other financial institutions and financial companies. The financial companies act as bill brokers between the banks and the business houses. So that's all about the discounting of bill. And the next one is venture capital. The venture capital is the financial investment in highly risky project with the objective of earning a high rate of return. The venture capital companies provide the necessary risk capital to the entrepreneurs so as to meet the promoters' contribution as required by the financial institutions. And in addition to providing this capital to the entrepreneurs, the venture capital firms also take active interest in guiding the firms. And the venture capital financing involves a high degree of risk because they are investing in risky projects. Moreover, the guidelines issued by the government for setting up of the venture capital companies are too restrictive and unrealistic and have come in the way of their growth. In addition to the venture capital companies, the Government of India has been setting up a number of other financial agencies to serve the increasing needs of the entrepreneurs in the area of venture capital. And that includes the venture capital scheme of IDBI, venture capital scheme of ICICI, the Risk Capital and Technology Corporation Limited, that is RCTC, and the Infrastructure Leasing and Financial Services Limited. Then the Stockholding Corporation of India Limited. They provide help in the transferring of shares and debentures. The SHCIL, Stockholding Corporation of India Limited. And another one is CRISIL, the Credit Rating Information Services of India Limited. They undertake the rating of the fixed deposit scheme, debentures, bonds, and they also provide credit assessment of companies. And the next type of fund-based service is housing finance. What is housing finance? It is the finance provided for building houses, and it emerged as a fund-based financial service in India with the setting up of the NHB, the National Housing Bank, in 1988. It is an apex housing finance institution in the country, and it is the fully owned subsidiary of RBI. A number of specialized financial institutions or companies in the private sector, public sector, as well as in the joint sectors have entered in the field of housing finance, such as LIC Housing Finance, HDFC, SBI HF, then ICICI Housing, and many others have also come up. These companies have designed suitable schemes for individuals, corporates, builders, as well as the promoters. And the HUDCO, as well as the commercial and cooperative banks, have even designed schemes specially for lower and middle income groups. So, the main aim of such finance is to support the people in building houses. The next type of service is insurance service. It is actually a contract whereby the insurer, in consideration of a sum of money, undertakes to make good the loss suffered by the insured. The insured is the policy holder. So they undertake to this insurance company undertake to make good the loss suffered by the policy holder against a specified risk such as fire or something else, and compensate the policyholder on the happening of a specified event such as accident or death. So it's an agreement between the insurer and the insured. Insurer is the insurance company and the insured is the policyholder or the beneficiary. The document containing the terms of contract between them is called the insurance policy. And the property which is insured is the subject matter of insurance. The interest which the insured has in the subject matter of insurance is called the insurable interest. Depending upon the subject matter of insurance, the services are classified as life insurance or general insurance. Then, to cater to the varying needs of the policyholders, a variety of policies are offered by the different insurance companies. The principal life insurance policies include endowment policy, whole life policy, joint life policy, etc. The important fire insurance policies offered by insurance companies are the specific policy, comprehensive policy, value policy, etc. And some marine insurance policies are also provided which insure against marine losses such as the voyage, time, mixed, etc. Such types of policies are called marine insurance policies. And until 1999, there were only two public sector organizations in the life insurance business. They were the Life Insurance Corporation of India and the General Insurance Corporation and its subsidiaries. They were providing the insurance services. The LIC provide protection against the risk of life, and GIC provide protection against accident, loss on account of fire, marine loss, theft, etc. And with the setting up of the IRDA, Insurance Regulatory and Development Authority in 1999, their monopoly has been come to an end and new players have entered into the field. The private parties or the private insurance companies have also entered into the insurance business field. The next type of fund-based service is factoring. Factoring means managing the receivables and collecting the receivables of the client by a financial institution. So, a factor is actually a financial institution that provides services relating to management and financing of debts arising out of credit sales. And this factor renders services such as bill discounting facilities offered by the commercial banks, and they also take upon the receivables of the company. They do the collection of the accounts receivables. They maintain the sales ledger for their client companies. They do the credit controlling and the protection from bad debts, provision of finance, rendering of advisory services to their clients. Such services, that is, management of the account receivables, are being done by particular financial institutions for certain companies who are their clients. This factor may be on a recourse basis on a or a non-recourse basis. Recourse basis means when these factors take these receivables of the company and approach their parties, and these parties are defaulting in their payment. In the case of a recourse factoring, this factor will collect it from their client. And in the case of a non-recourse factoring, in the case of default in payment by the uh, parties, the factor will not go back and collect it from their client companies. That risk will be borne by the factor. That is the difference between recourse factoring and non-recourse factoring. And there are certain limitations for these factoring services actually. That is the high cost of factoring when compared to other sources of short-term finance. It is a short-term finance, but other sources are much cheaper than this source, because the factoring is charged at a high rate by the factoring institutions, and the company that avail the factoring services are perceived as of having a financially weak position. So the clients of the factors are perceived as financially weak. These are the main limitations of the factoring services.